You're 19 years old, staring at EUR/USD at 2:13 in the morning, convinced the next candle will change your life. Your room is dark, your monitor is bright, a $500 account sits in the corner of your screen. You have a strategy, you have a reason, you have confidence. You believe the market is one good trade away from proving you right. You don't see the years ahead, the losing streaks, the missed weekends, the stress, the thousands of decisions where one mistake can erase months of progress. 15 years later, you're responsible for moving 8 figures through global financial markets while central banks reshape entire economies. The screen is bigger, the numbers are larger, the consequences are real. Between those two moments is a multi-trillion-dollar financial industry, thousands of losing trades, missed birthdays, chronic stress, and the psychological weight of risking capital every single day. This is every level of a professional trader's life. You're 20. Your first trading account holds $500, and every dollar feels like a fortune. At this stage, you're not a professional trader. You're learning how not to destroy yourself. The internet makes trading look simple. A chart, a pattern, a prediction, a trade. Reality is different. Most of your time isn't spent making money. It's spent discovering why you don't know what you're doing yet. Your first office is usually a bedroom, a kitchen table, a corner of an apartment. There is no trading floor, no institutional terminal, no team of analysts, just you, a laptop, and thousands of hours trying to understand markets. You open TradingView, you learn MetaTrader 5, you replay historical charts, you study economic calendars, you watch YouTube tutorials, you create journal entries, you build backtests, you download risk management spreadsheets, you create rules, then you break them, you discover strategies, then watch them fail. You change indicators. You move from moving averages to RSI. From RSI to Fibonacci. From Fibonacci to order flow. From one perfect system to another. The biggest trap is not losing money. The biggest trap is believing the next strategy will finally remove uncertainty, because the market doesn't work that way. A strategy that works during a strong trend can fail during sideways conditions. A setup that works in EUR/USD might fail in gold. A system that survives 1 year can collapse when volatility changes. You spend months looking for consistency, and months become years. You buy courses, you download PDFs, you follow traders online, you see screenshots of winning trades, you compare your beginning to someone else's highlight reel. Then comes the moment almost every beginner remembers. Your account is down. You know your stop loss is there. The plan says exit, but you don't. You tell yourself, the market will come back. It doesn't. You increase your position, you try to recover, the loss becomes bigger. 30 minutes later, an entire month's savings is gone. Someone finally tells you, respect your stop. 4 words, but they stay with you because you realize the market was never testing your intelligence. It was testing your discipline. The statistics are brutal. Retail traders face extremely difficult odds. European regulators require CFD brokers to display the percentage of losing retail accounts, and many brokers report that approximately 70% to 80% of retail CFD accounts lose money. The exact percentage varies by broker and jurisdiction. The first real victory is not a profitable month. It's a losing trade handled correctly. You take a setup, you lose, and you accept it. No revenge trading, no doubling down, no emotional decision. For the first time, you follow the plan, even though the trade loses. That is the first day you actually become a trader. You're 26. You trade every week. Welcome to a profession where your biggest opponent is no longer the market. It's yourself. Your account is larger now, maybe $10,000, maybe $25,000. Maybe you decide to use a proprietary trading firm because personal capital limits your growth. The modern prop firm world changes the equation. Instead of risking only your own savings, you pay an evaluation fee and attempt to prove you can manage a risk. A typical futures prop evaluation might cost around $50 to $200 depending on the firm and account size. Forex-style evaluations can range from roughly $50 to more than $1,000. Funded account sizes commonly range from $25,000 to $200,000, with some firms advertising larger allocations after scaling. But the money comes with rules. Maximum drawdown, daily loss limits, consistency requirements. You are not paid for being right once. You are paid for surviving. Your days become structured. You wake up, you check futures, you review overnight moves, you analyze the dollar, interest rates, oil, gold, equity indexes. You study CPI, non-farm payrolls, FOMC meetings, central bank speeches. You stop asking, where will price go? You start asking, what happens if I'm wrong? That is the beginning of professional thinking. Your desk changes too. 3 monitors, TradingView open, Bloomberg TV muted, Discord or Slack communities running quietly. Economic calendar visible, coffee beside the keyboard, a room built around uncertainty. Then one notification appears. A Fed announcement, an inflation surprise, a geopolitical event, your position moves. The market becomes alive. You close your charts, but your brain keeps calculating. You're driving, thinking about EUR/USD. You're eating dinner, wondering if gold will gap overnight. You're lying in bed, thinking about tomorrow's opening range. You wake up, checking futures before brushing your teeth. The laptop closes, your mind doesn't. Trading becomes an expensive profession. TradingView. Premium plans can cost around $30 to $60 per month, depending on features and billing. A MetaTrader VPS can cost roughly $10 to $50 monthly. A serious home trading setup can easily reach $2,000 to $5,000. 2 or 3 monitors, a reliable computer, fast internet, ergonomic chair, standing desk, mechanical keyboard. By age 28, you've invested thousands into creating an environment where you can make decisions, but the hidden cost is your health. Hours sitting, eye strain, back pain, poor posture, sleep disruption, high caffeine intake, energy drinks replacing rest. Your body is adapting to a lifestyle built around constant alertness. Winning trades create dopamine. Losing streaks create anxiety. A good month makes you confident. A bad week makes you question everything. You begin speaking the language of traders. You understand risk to reward. A 3-to-1 setup means you are risking $1 to potentially make $3. You understand drawdown, the amount your account falls from its peak. You understand liquidity, where large amounts of buying and selling can happen. You understand a stop hunt, a move designed to trigger clustered stop-loss orders before reversing. You understand spread, the difference between buying and selling price. You understand slippage, the difference between your expected execution price and the actual fill. You understand breakout, when price escapes a defined range. You understand pullback, a temporary move against the main direction. You understand position sizing, the calculation that determines how much you can risk. You understand volatility, the speed and size of price movement. You understand margin call, the moment leverage becomes dangerous and your broker requires action. These words separate someone who watches charts from someone who understands markets, because eventually you learn. Trading is not about predicting everything. It's about managing what happens when you are wrong. And that language becomes the difference between surviving another month or donating your account to the market. You're 33. You're a professional trader. You no longer celebrate winning trades. You celebrate following your process. That is the first major psychological shift. The market stops being a casino in your mind. It becomes an environment of probabilities. You are no longer searching for excitement. You are searching for repeatable decisions. At this stage, you might work at a proprietary trading firm, a hedge fund, a trading desk, or you might manage allocated capital independently. Your title may be professional trader, funded trader, senior trader, portfolio trader. The money is different now. The responsibility is different. A successful prop trader may control $100,000, $250,000, or even more than $1 million in trading capital depending on the firm and performance history. Large futures prop firms often advertise account sizes ranging from around $50,000 to $150,000 before scaling. Many retail-style prop firms offer profit splits between 80-20 and 90-10 after traders pass evaluation requirements, but the headline number means less than people think. A $100,000 account does not mean you can casually risk $100,000. You might risk 0.25%, 0.5%, 1%. Because professionals understand something, beginners usually learn the hard way. The first job of a trader is not making money. The first job is staying alive. Your trading changes. You stop taking 5 trades because you are bored. You stop forcing setups because you want action. You wait, sometimes for hours, sometimes for days. One trade. That's enough. Amateurs look for reasons to enter. Professionals look for reasons to stay out. Your morning begins before the market opens. 5:30 a.m. Coffee, overnight futures review, Asian session analysis, European market reaction, dollar strength, bond yields, commodity moves, 8:30 a.m., economic releases, CPI jobs data, retail sales, inflation numbers, 9:30 a.m. New York Open. The most liquid market session begins. You are watching order flow, not just candles. You are watching where buyers and sellers are actually fighting. You analyze VWAP, the average price institutions are trading around. You analyze ATR, average, true range, a measurement of volatility that helps determine realistic price movement. You mark order blocks, areas where significant buying or selling previously occurred. You study fair value gaps, price inefficiencies created by aggressive movement. You recognize BOS, break of structure, and CHOCH, change of character. The market is no longer a collection of random candles. You see a system, but you also understand the system can fail, because markets are created by people. Fear, greed, liquidity problems, unexpected announcements, central bank decisions. AI is changing this world. Large institutions now use artificial intelligence for execution algorithms, risk monitoring, market surveillance, and finding patterns across millions of data points. But AI has not eliminated human traders, because a machine can process information. It cannot always understand why a market suddenly panics, why investors change behavior, why liquidity disappears, why a crowd reacts emotionally. The trader is still responsible for the decision, and responsibility changes everything. A position is no longer a screenshot. It is capital, real capital. Sometimes your own, sometimes someone else's. Every click has consequences. The hours become strange. 7 p.m., you finish reviewing your journal, you analyze mistakes. Not just losses, mistakes. A profitable trade can still be a bad trade. A losing trade can still be a good trade. That is something beginners struggle to understand. Your journal becomes your mirror. You track entry quality, exit quality, emotional state, risk exposure, market conditions, patterns, weaknesses. The professional trader is not trying to eliminate losses. That is impossible. The professional trader is trying to eliminate unnecessary losses. The breaking point rarely comes from losing money. It comes from repetition, the same emotional battle. Every day, every week, every month, winning without becoming arrogant, losing without becoming desperate. Research into financial professionals has repeatedly connected high-pressure finance environments with elevated stress levels, burnout risk, and sleep disruption. The damage appears slowly. You sleep less before major economic releases. Your heart rate rises before important decisions. You check markets during dinner. You think about positions during conversations. Your family notices. You are physically present, mentally somewhere else. The cost becomes physical: eye fatigue, neck tension, lower back pain, weight gain from sitting, high caffeine consumption, constant alertness. Some traders eventually realize the uncomfortable truth. The account is not the only thing exposed to risk. The trader is too, so you invest in yourself: a better chair, a standing desk, a fitness routine, a sleep tracker, therapy, a coach, a personal trainer. Because protecting the person making decisions becomes as important as protecting the capital. Then something changes. A month closes positive, then another, then another. Not because you found a secret, because you stopped searching for one. A respected trader reviews your journal, looks at your trades, looks at your risk, and says, "Excellent risk management." And somehow, that means more than the money. You're 40. You're no longer measured by how much money you make today. You're measured by how much capital survives tomorrow. The title changes: portfolio manager, senior prop trader, chief trader, risk manager, head trader. The biggest change is simple. You spend less time clicking, more time managing consequences. Your job is no longer just finding opportunities. Your job is controlling damage. You review exposure, you analyze correlations, you monitor leverage, you evaluate liquidity, you prepare for scenarios nobody wants to happen. A position that looks small on a chart can become dangerous when everything moves together. Oil falls, the dollar rises, equities sell off, interest rates spike, correlations change. The market stops behaving like yesterday. Your role becomes protecting capital through uncertainty. Compensation at this level varies enormously. A portfolio manager at a major financial firm can earn several $100,000 annually, while successful hedge fund and prop trading managers can earn millions depending on performance, assets managed, and compensation agreements. The location matters: Chicago, New York, London. Each market center has different opportunities. Chicago remains deeply connected to futures and derivatives. New York dominates equities, hedge funds, and institutional investing. London remains one of the world's largest global trading centers. Remote firms have changed the landscape too. A trader no longer always needs a traditional Wall Street office, but the responsibility remains the same. Capital does not care where you sit. You miss parts of your old life, the early years, a clean chart, a quiet morning, finding one beautiful setup, trading without meetings, trading without investors asking questions, trading without explaining why a position moved against you. Because now every phone call matters. An investor asks about a drawdown, a partner asks about exposure, a risk officer asks about leverage. Every decision becomes a business decision, not just a trading decision. Professional infrastructure becomes expensive. Bloomberg terminal access is commonly reported around $25,000 to $30,000 per year per user. Reuters Workspace and institutional data services can also cost thousands annually, depending on access level. Then there are execution systems, compliance, legal expenses, brokerage costs, accounting, tax planning, cybersecurity, professional analytics, market research. A tiny improvement can matter. Reducing slippage by a fraction of a percent on large order flow can save hundreds of thousands of dollars over time, because institutions operate differently. A retail trader thinks about one trade. A portfolio manager thinks about thousands of trades. Then comes the moment every senior trader fears. A Federal Reserve emergency announcement, a geopolitical conflict, a flash crash, a liquidity crisis, a major investor redemption request. The screen changes, the market moves faster than expected. Phones start ringing. Everyone wants answers. Nobody knows the future. You manage risk. You reduce exposure. You make decisions. You stay calm. Because panic is expensive. 3 weeks later, you're sitting alone, performance report open, no celebration, no relief, just one number, maximum drawdown. Nothing else matters. You're 50. You've spent 2 decades trading markets. Now the responsibility changes one final time. You're no longer just managing trades. You are managing an institution. Your decisions affect employees, investors, partners, families, capital that belongs to people who trusted you. Your path might lead somewhere different. A hedge fund? A commodity trading advisor? A family office? A proprietary trading firm? An investment partnership? An asset management company? The screen is still there. The markets are still moving, but trading is no longer the entire job. Building the machine becomes the job. Because a fund is not just a strategy. A fund is a business. Before the first serious dollar is raised, there are costs: legal formation, regulatory filings, compliance systems, fund administration, auditing, prime broker relationships, trading infrastructure, cybersecurity, insurance, investor reporting, research, technology, risk management systems. A realistic hedge fund launch can require hundreds of thousands of dollars before reaching institutional scale. Some managers spend $500,000 or more building infrastructure, while larger launches can require several $1 million depending on staffing, strategy, and jurisdiction. The first capital rarely comes from strangers. It comes from reputation, years of trading, relationships, personal savings, friends and family, seed investors, family offices, institutional allocators. Nobody cares that you had a great month. They care whether you can survive 10 bad months. Because professional investors understand something. A strategy that makes money in one environment can fail completely in another. A technology strategy can fail during an inflation shock. A macro strategy can fail when central banks change direction. A trend-following system can struggle during years of sideways markets. Survival is the foundation. The family cost becomes real. 70-hour weeks, phones always nearby, vacations interrupted by market events, dinner interrupted by volatility, a laptop open during weekends, a central bank announcement becoming more important than your plans. Your children grow up seeing charts on screens. They know the sound of Bloomberg alerts. They learn that certain words change your mood. Emergency meeting. Rate decision, liquidity crisis, margin pressure. The market follows you home. Even when the trading day ends, it doesn't always end in your mind. The statistics are unforgiving. Thousands of investment firms exist. Thousands disappear. Hedge funds close every year because of poor performance, investor withdrawals, operational problems, or inability to maintain scale. The exact survival rate depends heavily on strategy, market cycle, and definition of survival. But the reality is simple. Most funds never become permanent institutions. The industry rewards staying power, not temporary success. A fund that survives 5 years has already accomplished something rare. Then comes the turning point. Year 4, Year 5, Year 6, something changes. Performance compounds, investors remain. They add more capital, they introduce other investors. Assets under management grow. The business becomes stable. Then one day, a larger financial institution calls, not because of one trade, because of years of consistency. A conversation begins, a strategic partnership, a merger, an acquisition, a larger platform. The company that once existed in a small office becomes part of something bigger. And then the emotional moment arrives. The office is empty, trading screens finally black, whiteboards covered with market structure, old journals stacked inside boxes, years of notes, years of mistakes, years of lessons. You remember everything, every blown account, every loss you thought would end your career, every margin call avoided. Every sleepless night before an FOMC announcement, every investor meeting where you wondered if people would continue trusting you, every month where survival felt uncertain. Then, the contracts arrive. Lawyers sign capital transfers. For a while, your firm's name stays on the door. Eventually, someone replaces it. You're 55, maybe older. Time has passed. You no longer remember every trade, but you remember every mistake, every stop loss you refused to honor, every market crash, every central bank announcement that changed your year, every sleepless night before a position you were too large to comfortably hold. You open TradingView once in a while, not because you have to, because after 30 years, looking at charts feels like reading your native language. You recognize patterns, not because they are guaranteed, because you've seen thousands of situations before. Your body tells the story. Your eyes tire faster. Your back stiffens after long sessions. Your sleep is lighter. Every phone notification still creates the same instinct. What happened in the markets? Even after retirement, years of uncertainty, years of probability, years of accepting that being wrong is part of making money. What did the markets buy? Your children graduated without financial pressure. Your parents retired comfortably. Your home is paid off. You created financial independence not by predicting every move, but by managing risk better than emotion. The stress never disappeared. The uncertainty never disappeared. Neither did the markets. But every day you participated in the largest financial system ever created. You learned discipline over prediction, process over ego, risk over excitement. That's the discipline. That's the price. That's the trader's life.